Here's the 30-second lesson on what legends know. Never practice nunchucks in a crowded room. Never eat chole before a road trip. Always take your shirt off before you iron it. Don't take a call near a swimming pool. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time we're going to be talking about the main event that's coming up in 1 week, which is the Interim Budget. To discuss what interim budgets are, what the government's finances look like, what are the likely announcements that are going to happen, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you, Radhika, for joining us.
Thank you, Sharad.
So, Radhika, let's start as we do with the basic question. What is the difference between an interim budget and a budget that happens every year?
So, a budget that happens every year provides authorization for the government expenditure and spending.
Right.
So, in interim budget, it will be, the full year's budget will be presented only after the election. So, interim budget is presented because the full year budget will be presented only after election. So, but we do need to have authorization for the period from, from the starting of the financial year till the new government joins in.
Absolutely.
So we do need continuity of policy, we do need continuity of expenditure, taxation regime. So an interim budget is presented and then elections are held, and after election, when the new government joins in, then the new government presents the full budget. So
Right.
That's the basic difference between interim budget and full budget. And interim budget is also called the vote on account. So
Right.
it seeks authorization for continuity of expenditure. Pending elections and pending the full government's functioning.
Right. So now, but we know that interim budgets come right before general elections.
Right.
So there's always the temptation of wanting to use the interim budget as an election tool, as a vote-getting tool. And regarding that, actually, we have a question from Gautam, who's one of our viewers and subscribers. He says, can we expect the government to ease up on its focus areas so far, such as capex in railways, infra, and the Make in India defense,
Right.
and instead keep a larger chunk for subsidies and election-related expenditure?
See here, if you look at some of the statements made by the finance minister, she has already made it clear that spectacular announcements should not be expected in this interim budget. So what we do feel is that the focus on fiscal consolidation will continue. And at the same time, the emphasis on capex will also continue.
Okay.
Not to the same extent as last year, because if you remember last year, the growth in capital expenditure was 37% over the revised estimates of the previous financial
Right.
year. So it was a big jump leading up to rupees 10 lakh crore of capital expenditure. But this time around also, given that private investment is still not picking up in a sustained manner, we do expect that the budget's focus will remain on capital expenditure, though at a slower rate. We expect likely that around 12 to 15% growth over the revised estimates of the current financial year
Okay.
should be targeted as capital expenditure for the next year. Also, what we are seeing based on the data that we get from the Controller General of Accounts till now, the outlay on subsidies is not very high. So what we do feel is that the government would be able to achieve its subsidy target for the current financial year. And even for the next financial year, the allocation for subsidy is going to be more or less same as the current financial year. So the food and fertilizer subsidy allocation was 4 lakh crore in the current year. And what we expect is that the allocation for fertilizer subsidy could go down because fertilizer prices have come down, imports of urea have come down since the highs of 2022 when commodity prices were very high and fertilizer allocation, subsidy allocation had to be increased to more than 2 lakh crore.
Right.
So now we expect if there's except for a situation where there could be another shock or sudden rebound in fertilizer prices, but what we do expect is that fertilizer subsidy bill is going to be more or less flat. Food subsidy bill, we already know that government has announced the extension of the free food grain scheme by another 5 years. So that is expected to continue. So overall, subsidy bill is not going to explode. It's going to remain within limits.
That's actually very good news, because
very good news.
A lot of people are expecting that before the elections, there is going to be a big jump in the promised subsidy amount.
Yeah. So what we could see is that the existing schemes of the government, the existing welfare schemes like PM Kisan, like the Rural Jobs Guarantee Scheme, that could see an enhancement in allocation, but we don't see a big ticket announcements or a steep jump in subsidies. So that has been, if you see the track record of subsidy allocation, that has been the case, that the expenditure on subsidies have been rationalized, leaving aside the last financial year where subsidy allocation had to be increased because of global headwinds. So other than that, even accounting for the first supplementary demand for grants that we discussed, during which time 58,000 crore of additional expenditure has been allocated, within which 13,000 crore is for fertilizers, but cumulatively taking the account of all this, we feel that fertilizer subsidy bill and overall subsidy bill for this year as well as for the next financial year is likely to remain within limits. It's not going to be too much different from the present year's budget estimate, and the focus shall continue to be on fiscal consolidation.
Okay, and now we know that budget making is as much about revenue as it is about how the government spends its money. So now revenue also comes in the form of direct taxes, indirect taxes, and also non-tax revenue. So can you tell us a little bit about how these numbers are looking and what we can expect?
Yes. So firstly, looking at the receipts position, there are two kinds. We have the revenue receipts and capital receipts. Within revenue receipts, we have the tax revenue and non-tax revenue. Within tax revenue, we have revenues from direct taxes and indirect taxes. Non-tax revenue primarily includes the dividends that government gets from PSUs and from RBI. And we've seen very encouraging numbers on non-tax revenues in this financial year because of RBI's more than expected payout of dividends to the government. So that is the revenue receipt, which includes the tax revenue and the non-tax revenue. And on the capital receipts, leaving aside the borrowing, what we have major proportion is coming from the non-debt creating capital receipt, which is in the form of disinvestments, asset monetization. So those are the broad components that we can, think about, analyze that what will happen in this financial year and what's going to happen. What is the likelihood of their trajectory in the coming financial year? So let's talk about the tax revenue first. And if we talk about the tax revenue, looking at the direct taxes in particular, they have been doing very well. So direct taxes growth from April to November has been more than 25%. Over the April to November of last financial year, and it's driven by both income taxes as well as corporate taxes. So direct taxes have done well, and this is, if we compare it with what was announced in the budget target was 10.5% for direct taxes. But the growth in this period from April to November has been above 20%. So based on these trends, we can safely assume that the government will surpass its direct tax estimates.
Target
that is for given. On indirect taxes, we are not doing so well. We are actually lagging in terms of the budget estimate. So again, the budget estimate was 10.5%, but what we see from April to November data is 5%. So that is again due to trade slowdown, and that's resulting in reduced collections from indirect taxes. But cumulatively, considering both direct and indirect taxes, what we can see is that the net tax revenue of the government will be more than what they budgeted in the current financial year. And over and over and above that, even for the next financial year, it is expected around 10 to 11% growth. So again, healthy growth
That's strong.
is expected to be strong. And this is again noteworthy point is that our base nominal GDP growth has been lower. Right. So nominal GDP growth was assumed to be more than 10%. What we actually got was 8.9% as per the first advance estimate for the current financial year. So even if our nominal GDP growth is only 8.9%,
right,
we are getting a direct tax revenue growth of above 25%. That means that there is the buoyancy of tax revenues have improved.
And our tax to GDP ratio will look a lot better. Everything,
yes.
Right.
Yes. So in relation to GDP, our taxes will look a lot more better, and which is expected to continue in the next financial year as well, mainly driven by the encouraging performance of direct taxes. So we have seen that, if we look at the last 2-3 years, government's tax estimates have been quite conservative, and the government is able to meet those targets and surpass those targets even with an unfavorable base in the form of a lower nominal GDP growth. So that's the extent of, improvement in tax revenue that we have seen, that despite an unfavorable base, we are getting a good collection, particularly from direct taxes.
Right. Okay.
The only one point to note here is that going forward, the corporate tax collection may see a slowdown because now profits have started to normalize.
Right.
If you see in the third quarter, the corporate profits have decelerated a bit. So the period of very strong profit growth that we saw in these 2-3 quarters contributing to strong corporate tax collections may not continue, and therefore there is some normalization of corporate tax growth. But even then, we do think that the tax collections will grow by 11 to 12%.
So now that's the tax revenue side of things, but there's also the non-tax revenue where, from what I've seen, there's very healthy dividends that have been coming in.
Yes.
But on the other side, disinvestment hasn't been that great.
Yes. So those are the two, offsetting factors, that on the one side, non-tax revenues have done well in terms of healthy dividend. But if you look at the disinvestment receipt, the target for this year was 61,000 crore.
Right.
And by this time, April to November, the collected amount is hardly 12,000 crore.
Oh.
So there will be a substantial scaling down of disinvestment receipts in terms of the revised estimates that will come out for this financial year. It's expected that the government will not be able to meet its target, and there will be a substantial phasing down of the disinvestment estimates for the current financial year.
Right.
And if the government tends to become more realistic about disinvestment receipts, which it should, then we think that for the next financial year, the target should be kept, lower, and it should be around 25 to 30,000 crore for the next financial year, given that this time there has been a considerable underperformance in disinvestment receipt. So given the past trend, it is likely that the government will scale down on its target for disinvestment receipt, and the comfort it will get is from the taxation side, direct taxes.
Right, and also the strong dividends.
And also the strong dividends, which are again expected to increase by around 4 to 5% over the revised estimates of the current year.
Okay, and now there's one sector of the economy. I mean, even though GDP growth has been reasonably strong, the agriculture sector, rural demand has not been that strong. It's not been as strong as other sectors have done.
Right.
So can we expect in the budget some aid for them?
Yeah. So that is a valid expectation, even though we don't see, on the one side, we see that consumption has been weak. We saw from the first advance estimates that the growth is mainly led by investment, but consumption side is weak. And if it would have been a full year budget, there would have been legitimate expectations around boosting consumption, introducing measures to boost consumption in the form of increasing tax rebates or standard deductions on the taxation front, and also some concerted measures for revival of rural consumption.
Right.
Now, considering that it's an interim budget and convention shows that we don't see great overhaul in taxation regime during the interim budget. It may well happen. Nothing stops the government. But going by the convention, what we can expect is that there could be some measures to boost at least the rural consumption. There could be some increase in allocation for the government's already existing welfare schemes like PM Kisan, where cash handout could be raised from rupees 6,000 to rupees 8,000.
To some amount, right.
To some amount. There also what is expected is that the allocation on rural jobs guarantee program, the Manrega, which was substantially scaled down last year to 60,000 crore, and that was seen to be a substantial underestimation of
because they anyway had to revise it up.
They had to revise it up. So, and there are some pending dues as well. So we can expect an increase in allocation for the rural jobs guarantee scheme. And the other thing is, I think a lot should be done also towards employment generation, and one instrument for that could be the low cost housing. What we've seen last financial year, the allocation for PM Awas Yojana was increased by 66% to a big number, I think 69,000 crore. So we could see retained focus on these low-cost housing, emphasis on the rural sector through PM Kisan, emphasis on the farm sector through enhanced allocation of increasing the target for agricultural credit, because still large proportion of farmers depend on non-institutional sources of credit. So there could be this increase in target for agri credit and interest subvention to some extent, what we saw,
encourage them to take the credit
from formal means. So I think these are some of the schemes which are already existing, and we could see some upward revision in allocation.
Enhancing these schemes,
rather than coming up with an altogether new scheme. That is the expectation.
Right. So now overall your sense then is, from this interim budget, do you feel it's going to be over the top spending, as a lot of the government's critics fear it might be because the elections are coming up? Or do you think that it's going to be much more prudent?
So I think there will be a balance between fiscal prudence, maintaining the path of fiscal prudence, and some measures to support growth, where particularly in sectors where it is weak, like we mentioned, we talked about rural consumption and measures to boost consumption. But on fiscal consolidation, I think the emphasis would continue, and even in the current financial year, despite the shortfall on the disinvestment received, government is expected to come close to its budgeted target of 5.9% of
come GDP. Close? You don't feel it will actually meet it?
It may make also, because the point is that your nominal GDP growth is low. So it all depends what happens in the next 3 months are going to be critical. But the fact is that the government will be either closer or it will be able to meet its target. So it will not be a substantial deviation from its 5.9% target, mainly due to, as we mentioned, the buoyancy in tax revenue. There could also be some expenditure savings. Mainly coming from revenue expenditure side, because if you look at the CGA numbers, the Controller General of Accounts, the numbers that we get for April to November, we see that expenditures both on the capital front and on revenue front have slowed down in the last 2 months. So there could be some expenditure savings, and then there is better tax revenue collection. So these could help offset the shortfall that may arise due to the lower nominal GDP growth. So on balance, we do expect government to be able to achieve its 5.9% target, and also stick to its medium-term glide path, which is difficult. We all know that the government has repeatedly reiterated that its medium-term goal is to come to 4.6% of GDP fiscal deficit by 2025-26.
Which is a tough target.
From, even if it achieves 5.9, it means another 1.4 percentage points reduction. That means 70 basis points reduction each year. And that is a very difficult target. So what we do expect is at least a 0.5 percentage point reduction. So mostly people are considering either the target will be in the range of 5.2 to 5.4%. We think that it will be around 5.4% because, the government should not be drastically cutting its expenditure.
It's spending, right.
Yeah,
we still need growth.
We need growth at a time when consumption is low, at a time when the economy is subject to multiple global headwinds. So because of all these reasons, and also, very important thing, if you look at the trajectory of total expenditure to GDP and total revenue expenditure to GDP, it has been consistently falling after the increase in the COVID period. So there has been a steady decline while the capital expenditure to GDP has risen, but total expenditure has, as a percent to GDP, has been shrinking. So even if the government wants to, so currently it is around 15%. So the budget size is 15% of GDP. So even if the government wants to maintain it, it cannot drastically cut its fiscal deficit target. So,
and I understand. Right?
Yeah, and that would have been possible if we are getting a nominal GDP growth of say 15 to 16%, which we are not. Which we are not, and it's not expected. Again, the government is likely to assume a nominal GDP growth of 10.5% at most, which again we could be an overestimation, and we could again end up having a nominal GDP growth of 9 to 10%. So given these scenarios, I think the reasonable way to move would be to have a fiscal deficit target of 5.4 to 5.3% of GDP, and again having another 40 to 50 basis points reduction in the next financial year, which gets it closer but not achieving the 4.5% fiscal deficit target, because you can't go about drastically cutting even the revenue expenditure. Revenue expenditure is also needed to carry on the expenditure, and we have seen shrinkage of budget size, but beyond a point, if budget size is shrunk further, it will be detrimental to growth. Which they don't want. Yeah.
So there you go. I mean, so the budget 1 week from now, we can expect a focus on capital expenditure as the government has been doing so far. It might not be quite as much as last year because that was a huge jump, but it'll still be significant. The subsidy burden, surprisingly, is not expected to grow very much from what it already is. Everybody expects that, elections are coming and so the budget's going to have a lot of subsidies, freebies. That's not the expectation. There are other signs where, where the government needs some attention. There's disinvestment receipts, of course, are very low compared to what was targeted. But on the other side, dividends and tax revenue, especially direct tax revenue, has been strong. Indirect tax revenue has not been strong. So that's something it might need to put some attention to. The agri sector is likely to get some help, especially to boost the sector itself, and as well rural demand, because that's one area that's been lacking. But overall, it's going to be a responsible budget. It's not going to be that we're just going to throw money at the problem. So that's all we have for you. Thank you so much for watching.